Okay, hello everyone. Welcome to this live intraday strategy webinar on SB Trade Desk. Michael Boutros here with you this morning, guys. Alan, Ferris, Graham, great to see you all in the room. Mario, Mir, Pete, good to be here with you guys. So, welcome to FOMC week. Today starts the two-day meeting with the Fed. Obviously, tomorrow is going to be the release. A quick reminder, tomorrow's midweek strategy webinar gets pushed back till Thursday. Obviously, Jamie's not going to want to be doing his webinar in the midst of the release. So we're going to kick that back till Thursday. I'm still going to have the regular intraday session tomorrow morning. And then we'll have Jamie pushed back till Thursday so we can get in some of those FOMC remarks. So as it stands right now, a quick look at price action for the US dollar ahead of the release or ahead of the FOMC meeting. You pretty much have a dollar that's stronger against all its major counterparts. Biggest loser on this session is actually the British pound. He did get some weaker than expected CPI data. We talked about that last night in the update. We'll go over that. New Zealand, second loser, down 0.81%. Aussie, down 0.51%. Kiwi, we do have at near-term support, so we'll go over that in a moment. Aussie broke support and is testing former support as resistance, so we'll talk about that as well. Interesting setup there. Keep in mind, for the Australian dollar, or for the British pound, excuse me, you still have a big week ahead. Okay, although we got CPI numbers today, obviously the Fed is going to impact the sterling dollar. Then you have the BOE. Then you have ILO 3-month unemployment rate from the UK. And then obviously the main event next week heading into the 23rd will be the referendum vote. We keep getting different polls on this, guys. And we'll go over this again when we talk about the sterling in just a moment. But these polls are going to continue to generate a lot of volatility. So if you're trading sterling crosses, stay nimble, reduce leverage a little bit is my recommendation to you until we get that event risk out of the way. Okay. The final result of whether the vote will be to leave or not, the impact of that on price action, will leave that when we get there. We'll cross that bridge when we get there. But heading into the release, you're going to get a lot of chop. So make sure we're really just paying attention to the levels, and we'll go over those in just a moment. Good morning, Adam. Great to see you in the room, man. Okay. Let's just jump into the dollar, I guess. As always, guys, if you have any specific trade setups you'd like to review or pairs, feel free to throw them on the message board, as well as any questions with regards to strategy. Okay, so heading into the release, here's what the dollar index looks like. The daily chart, again, still remains pretty messy. If you take a look at the radar charts, I haven't changed them for the last couple of days because they're still exactly where we left them. Okay, dollar index, gold, and crude checking near-term support at this point, testing a break of the weekly and monthly opening range. So we'll take a look at that. Gold has continued to rip face. So, I'm not really doing anything on the gold front, but from the dollar index, here's what the interest rate probabilities look like heading into the release. And again, this is something that we'll continue to monitor. I'll put this in tonight's update, guys, and then I'll give you another update right before the FOMC. But we like to look at Fed fund futures as sort of a gauge of what the market's pricing in as far as interest rate expectations moving forward. So obviously this month's print has a 0% probability of a hike, 2% for a cut. That's negligible. No one's going to pay attention to that column at this point. The most important thing, and the thing I wanted to note today, is that over the last couple of days and weeks, we've talked about these Fed fund futures rates, guys. And if you noticed, February was the first month that we saw material expectation, meaning above 50%. That's dropped to 47.9%. So market expectations are now kicking out the first or the next interest rate hike till past February of 2017. Okay? Interestingly enough, that shift in the longer term outlook for rates has not impacted price. So in my mind, that still leaves the dollar vulnerable. Okay, heading into the release. Don't put it out of the realm of possibility for check of the 100-day moving average or basic trendline resistance or slope resistance here, but the broader rally remains at risk. Now, if we continue to see that February, print plummet, or if on the back of the release you see a dramatic change in these, whether it's brought forward or back, that'll have larger implications for the medium-term trend in the dollar index as well. Okay, so continue to track these. The only thing I wanted to highlight this morning is you're seeing those far out expectations get kicked out even further, with the dollar really not showing much of a reaction to that. So again, leaves the sort of near-term focus for the upside on the dollar at risk. Here's what the index looked like again last week into the close. Near-term resistance targets 1188, 11887, 11902. Then you had the key 618 at 11927. Here's what the 30-minute chart looks like now. All right. So, whoop, wrong chart. There we go. So we basically came right into that trend line resistance. There's that 618 retracement at 11,927. We came right into that as resistance in overnight trade on a topside break of basic trend line resistance. Now we're noting some momentum into that high. So again, suggesting the topside might be a little vulnerable here. As a disclaimer, I am holding a dollar CAD short. I think dollar CAD came into resistance earlier today. We'll take a look at that. Near-term resistance confluence, and alongside the dollar with this rally here kind of maxing out near-term at the 618, looks like a near-term move that you could catch to the downside. I do want to say that dollar CAD has the likelihood here of rallying towards, even 130.90 at this point. This is just a scalp, and we'll go over that in a moment. But any questions on the dollar index here before we move off? Does this constitute a break of the weekly opening range? Technically, we did top it, but with near-term resistance and that key 618 there, I'm going to continue to use this as the opening range high for the week, 11,927. A topside break there, if we do get it on U.S. trade, you're looking at a soft target at 11,950. More importantly, the 100-day moving average comes in right around 11,965, 966. Okay, but I'm looking for some resistance here in the dollar index heading into the U.S. Open. Again, at its inception, equally weighted Aussie, Euro, Sterling, Yen. So the dollar index, the Dow Jones FXCM dollar index here, a really nice representation of base dollar movements. Mir says, do we have access to those prints of the US dollar expectations? Are you talking about the Fed Fund futures, Mir? You do not. If you're talking about, yes. So this is the Bloomberg terminal. This costs like $2,000 a month, Mir. So I really don't think the retail trader is going to need something quite in-depth. As far as this is concerned, though, Mir, I do put this on any report where I see that this is going to be pertinent. So if you go back through the last couple of intraday updates on the dollar, I do have this covered for you. So don't worry, I'll bring it up when it's important. And for sure on SB Squawk as well, you'll see that come up when it pertains to what's happening price action. All right? Mir says, okay, right on. Also, feel free, Mir, to take a freeze frame of the screen. For anyone here who's new to the room, there's a camera button, top right-hand corner there. Go ahead and click on that to take a snapshot of any of the charts that you see presented. All right, so let's see if this dollar index rally continues. I do think it starts to fizzle out sometime soon here. And if we do break that 618, again, look at that 100-day moving average on the upside. For that rally to extend. Near term or broader term on the dollar chart, basic sliding parallel for the current operative slope we were following for a few months there, extending off the high from last month, comes in just ahead of that 100-day moving average, which is at 11,966. So if we do get the break, that's sort of the initial region of resistance I would look for. But right now, you are checking the key 618 retracement. All right. Okay, so let's jump into yesterday's update. First on tap was Aussie Dollar. Here's what the Aussie looked like. Well, let's take a look at the daily chart first, which is a little bit messy, but the basic premise that we were looking for here on the Aussie yesterday was I was looking for some near-term support. This is a big region. You have the high day close that we made back here in October. You had the median line extending off the high. You had a longer term median line. This is, well, let me snap these levels for you. Okay, so you had the median line off the high, the October high day close, and then the 50 line for the current advance here, right, of this formation that we've been following off the low. We're breaking below that now. Look, this is technically the bullish invalidation level. It's a couple of reasons. A, right here, this break that we made last night in early, this is ahead of the European Open, I guess, would be a constitute of the initial weekly opening range low. So break below that keeps the focus lower sub 73.60. So near term, heading into the US Open, I'd be looking for a rally towards this region to see if we hold that as resistance. If it does, specifically if you get a nice short trigger off that, I think that might be a nice decline. You'd be looking for only a drop initially into 73.23, basic 50. More importantly, 72.82 remains paramount. 72.82 is actually the yearly open for 2016 and also represents the key 618 retracement of the advance. So the downside targets are pretty clear here. All right. Near term, 73.60 is the resistance you need to see hold for that downside bias to remain in play. If we break above the median line, we'll stay neutral here. A breach above 74 is needed to get the upside bias back in play. Okay. Again, if you put a gun to my head, guys, I still do like the concept of an Aussie rebound here. But from a technical standpoint, on a threshold standpoint, what we've broken below, sub 73.60, you're at risk. Okay, so I just want to highlight that setup. The levels unchanged from last night. Again, here's what the scalp looked like. We're looking for a drop into this region. As I noted yesterday, I'd be looking for long triggers for a long position off that region. Well, the collapse that you saw in late Asia, early London, didn't really give you much confidence to see any type of rebound. If you look at this in near-term price action, you also didn't get much play. The 4 o'clock print for CPI certainly, or sorry, that was Aussie. Well, we'll go over that in a moment, actually, on the sterling, that CPI print from this morning. But the drop that you saw here in late Asia, early London, again, not much conviction on trying to fade that move. So we'll see if the resistance holds into 73.60. And again, downside targets are pretty clean. 74 now being the bearish invalidation level for Aussie. Any questions on the Aussie setup from last night? And again, if you take some basic channeling action, right, mimic this to the lows, you can see that that caught the lows pretty well. Look where that lower median line parallel converges heading into tomorrow's trade session. Right into that confluence region at 72.80. All right, so sub 73.60, that's our ultimate target. 74 is the bearish invalidation. Amir and Gary, I see your questions. We'll definitely go over those setups. Just give me 1 minute. Gary says, would you take a look at the abomination? We'll do. Gold for sure recovering either way, Amir. And sterling yen, yes. Yes, we'll go over that for you. No problem. Any questions on Aussie before we move off? So as far as Aussie data is concerned, I think we're pretty spent until we get the employment numbers on the 5th. Yeah. So the employment numbers that we get tomorrow is going to be the next and pretty much the last major event risk for the Aussie dollar, aside from the Fed heading into the end of the week. We are expecting a build of 15,000 jobs for the month of May. It's off a previous read of 10.8. Obviously, unemployment is expected to hold at 5.7%, and this is the highlight. We're actually expecting to see an uptick in labor force participation for Australia from 64.8 to 64.9. Okay, and if this pops up to 65, let's say, and this drops down to 50 or 5.6 or 5.8, excuse me, pops up, that would still be a positive read. Remember, the broader the labor force participation, the healthier the gauge of the labor markets. So that is Aussie dollar. Next up on tap was the British pound. And here's what the pound's looking like. Again, suffering a little bit from last night's poor read on CPI, or earlier this morning, I should say. Here's what the UK data looked like from this morning. So you saw a month-on-month CPI come in at 0.2, slightly softer than expected. Core year-on-year, which is the headline read, let's call it, came in at 1.2, softer than expected. That is a hold from what we got the previous month, but we were expecting an uptick to 1.3%. Not going to be a major, game changer by any means, guys. And the and the sterling, as I said earlier, has a huge 9 days up ahead. Okay, you have obviously the Fed, the unemployment numbers, the claimant count comes out tomorrow as well, right ahead of the Fed, and then you do get obviously the BOE, the final, the next day ahead of next week's referendum. So for the pound, keep the powder dry, stay nimble. Okay, we'll continue to play this one as we get closer to the referendum, but certainly those CPI numbers weighing on price. So I noted yesterday that sterling had set a basic weekly opening range. I highlighted the scalp chart here on Daily FX as well. And you're basically looking for a downside buy sub 44.80, which is the bearish invalidation level. Near-term resistance, 43.05. Long story short, guys, you got a little blip on the radar here, but we're right back at 41.20, which is near-term support. Here's what it looks like on the daily chart. And we'll jump into the 30-minute. So daily chart looks like this. It's pretty messy at this point. I recognize that, guys. I'm not really a big fan of the pound per se, but certainly heading into the event risk, we should have the levels all mapped out. So as long as you stay below the median line near term, you're at risk for further losses. I do want to say that this thing is struggling to break below 40 in momentum. 41.20 is not a random level. That is the low day close from April and has continued to offer some support. You got the 50 line off the highs there, also in play. Here's what it looks like on the 30-minute chart. So 41.20, that low day close from April, continuing to hold a solid support near term. All we've done is set a pretty basic weekly opening range. Stretch into a new high, test that high, fail, test the lows, fail. You're looking for a break of this range. Broader biases to the downside, sub 44.80. I know it's a ways away from where we are now, but a huge region of resistance. It's the June open, it's the upper median line parallel, and over the next few, well, heading into tomorrow, not the next few days, it'll also converge on a basic median line parallel, extending off that low from April. So bearish invalidation, break below 41.20. Looks for a tag of that 40.60 level. And again, the 140 handle will be a subsequent target to the downside. Haven't personally taken any trades per se on sterling, guys. Been a little bit shook on this one. Again, those polls keep on coming out. Yesterday, midday, you did get a poll that showed a 6-point spread in favor of leaving. I do want to note that these polls aren't necessarily going to reflect what will actually happen. If you recall, the last time around, we got the Scottish referendum. The polls were completely, at odds with what actually happened, and they obviously voted to stay. So, don't take too much coin in those releases, okay, in all those polls. We're only, 9 days away now for the vote, and, any longer-term implications that you're trying to take, or any longer-term trades you're trying to take based on this event risk really won't have merit until then. So from here, Mike, that's great. Where were you looking from here heading to the into the US Open? From here, I wouldn't be too surprised to see some upside play. Remember, some near-term weakness in the dollar would be very welcomed. I don't expect the dollar is going to sell off too aggressively ahead of the Fed. If anything, it might be a slow dribble. So you could see a little bit of a rally here. Again, we'd be looking for near-term resistance targets and short triggers heading into those upper parallels. Okay, my notes say weekly opening range is preserved. Big week still. Yeah, I went over that. Okay, so that is the British pound. And Amir, why don't I do this for you right now? Why don't I jump into the pound yen as well? Here's what pound yen looks like. I haven't been tracking this one on a near-term prospect. Amir, was that you that emailed me earlier in the week? Our intern passed over an email from one of you guys. Yes. Okay, great. I hope you got that chart. So here's what I'm looking for. I think this is what I sent you. So you had some interesting support targets that you're coming in. If you looked at yesterday's swing update, Amir. Also, Jamie has a chart that he has highlighted as well. He's looking for like 47. Here's what that looks like, by the way. I got you, my man. I got you. Here's what Jamie's looking at. So he's looking at that 47 level as some near-term support. It's the key 618 retracement. We have that marked, but also some parallels are converging on that. The 2000 low comes in at 48.20. So that's a level I'd be looking at as immediate support ahead of that 47 level. So near term, Amir, you're looking for targets between 151 and 147. I'd be looking for that 2000 low. Okay, this is a monthly chart, keep in mind. It comes in at 48.20. And then off the low here, you have 47.02. Let's just call it 147. Near term support. From my standpoint, on an intraday level, there's that 47 handle that Jamie's looking at. Same level, the 2000 low comes in at 48.20. So let me mark that up. Okay. So Amir, a quick recap once more for everyone in the room here. So the immediate ML that we're trading within, the formation that we're trading in off that September high low, or low high, I should say, gives us a median line support right now. I also want to highlight the broader formation that we were trading in off the highs from December of last year, a sliding parallel of that slope has caught not only this low from May, but the low that we made earlier in the year in April, and converges on this region right now. Let's see what the scalp chart looks like. Okay, that's null and void. That's a new low. And I want to see if the weekly high is different from the weekly open. Weekly open comes in at 152.25.6. 152.25.6. Okay, pretty close to the weekly opening range high. Yeah, I don't have anything beyond here, Amir. So he's looking for targets between 47 and 51. So I can't tell you that I have anything ahead of 47 if we do break this low. Remember a couple of things, Amir. First, you're talking about a pair that has a much wider ATR. Sterling Yen on a daily basis has a 237 pip ATR. So a stretch into 147 or 148.20, that's not too far outside the realm of possibility on the near term. Let me add that 48.20 level. Oh, I just did, right? 48.20. And those would be the levels I'd be looking at near term. Those are the levels I'd be looking at near term. Be cautious on this one because I think you can get a double whammy heading into Thursday, specifically post FOMC. So if the yen really finds a let me take a step back, guys. What you're seeing and what we've been seeing, and if we take a quick look at relative performance, I don't know if this is going to carry over today, but let's take a quick look at relative performance looking against the yen as a base. Right. So you can see how strong the yen has been, guys. This is just from the 9th. Let's look until today. Okay, from like last Friday till today. You can see that the yen is stronger against all its major counterparts. Specifically, the yen being the biggest loser, down 3.16%. And what this is saying to me, and if you take a look at what's happening not only in the yen market, but what's happening with the dollar, which has been coming off its lows, I wouldn't say it's been a strong rally, but certainly has been rallying. And gold, it seems to me like you're getting that scent of risk-off behavior in the markets. And certainly, if we look at the equity board, we've been seeing some multiple day or some back-to-back days of losses. Here's what the S&P 500 looks like. The pullback in risk, the rally in gold, the rally in the dollar, the rally in the yen, all indicative of some near-term risk-off flows or haven flows, whatever you want to call them. A move from higher yielding assets to lower yielding, safer, lower beta assets. So if we take this into account, that suggests to me that if we do see some further yen strength, even though we're looking for some possible rebound play on the pound, you might not quite get that upside thrust just because of the strength that you're seeing in the yen, sort of keeping this under wraps. So yes, I do like the downside still. I would have to see a near-term break above 52.25 to invalidate the near-term, the immediate downside bias. You're getting some divergence into those lows. So I do think this is primed for a little bit of a bounce. Inevitably, I would be looking to sell that. On the most near-term rally, if we do find a low here, and this is way too early, but Amir, just for your consideration, if you do end up chasing, or if you do end up trading this, or you're looking for an entry, if we just take a basic retracement off that high, and the other thing I want to check out is the 50 line of this formation. Bear with me one more moment. And trust me, I've spoken to the developers at FXCM. Hopefully they'll make it so that we can copy pitchforks instead of doing this nonsense every time. But there's always a lag here. Okay, well, I'm going to adjust this before I publish it for you guys, but just to give you a picture of what I'd be looking for here, see if this parallel, gives us any play. Come on. Okay, so there you go. So that puts like the first area of focus is 52.60 on a simple rebound play. And that converges on a basic 236 and those lows heading into like 52.50, 52.60 here. Possible re-entry for the short side. Again, it's way too early to use this as a confirmed retracement, but that would be sort of the near-term game plan I'd be looking for pound yen Amir. The key levels for the downside, all you need to know if we break this median line is basically just the 148.20 level, the 2000 low, and that key 618 at 147. That's basically all you need to know, Amir, as far as downside targets. Okay, because I think you were asking that in the email. Thanks, mate. He says, anytime, Amir. Anytime, my friend. Thanks for bringing it up. And it's a very interesting pair. I think the volatility for me is just a little bit too big ahead of all the sterling event risk for me to really get involved, but looks pretty good. Okay. Moving right along. So we went over Aussie dollar, we went over pound dollar, making decent time here. Last night we also spoke about Kiwi dollar, which was coming into, or right now, ahead of the webinar, last time I looked, was coming into confluence support. This is another one I really do want to get involved in. Looks like I may have missed the near-term entry here just for this bounce, but we're basically looking for some support heading into the 70 handle. This is a simple soft target, but you're looking at the lower median line parallel here of the formation dating back to the lows we made in May. If you take some basic channeling, so here's a basic trendline resistance, take a parallel of that off the lows, you can see that the low converges on that median line also today. So I'm looking for this thing to settle out, long story short. If this uptrend is going to hold, this is where you need to find some support. If this breaks, I'd be looking like the Aussie dollar is right now. I'd be looking for a check of former support as resistance to sell back into 69.10 and more critical support into 68.54, 68.66, this region here. The daily chart for the Kiwi is pretty ugly. Here's what it looks like. Excuse me, on the daily prospect. So here's that major key support or former resistance, now support that we talked about for months and months and months. It now converges on that longer term trendline resistance. And this is basically the make or break level and why we're looking for that 70 handle, 69.70, 30 pip range to really be the key support near term in the Kiwi. Really, this is make or break. So I feel like I kind of missed a little bit of a bounce here. Be looking for that only to play it towards like 73 or 70.30, excuse me. Basically those lows that we made in early Asia on Sunday, trendline resistance. That's it. I'd need to see a break above the median line here to really get more aggressive with looking for a bigger chunk on the upside. Remember, the ATR has been contracting here. So you're looking at about 19 pips per scalp. So stay nimble, but levels look pretty good. Here's what the Kiwi looked like last night. And again, that drop into key support, we just got it. As I said yesterday, I'd be looking for long triggers, long exposure into this region. Any questions on Kiwi? Pooja says Aussie checking resistance at 73.60. Yes, it is. Let's see what this looks like. Okay, so here's what the profile looks like on a 5-minute and a 1-minute chart for Aussie dollar at this point. You're setting a really nice opening range for U.S. session. We've obviously probed through that 73.60 level at this point, so looking for some exhaustion. But what I can tell you is this: the near-term momentum profile, Pooja, doesn't look all that convincing for me. You're seeing support at 40, multiple breaks above 60, both on the 1-minute chart. Oh, this is also a 1-minute chart. Let me just see what the 5 looks like. Yeah, and this is your first break into 60 here since last night. Sort of a near-term trigger I'd like to see go, but I don't like that we keep probing above 60 here. It's not what you want to see if this thing's going to turn around more abruptly. All right, we'll come back to this one. Any questions on Kiwi dollar, though, before we move off to the next pair? All right, last but not least from last night, here is dollar CAD. So another one where we were looking for a rally to find some near-term resistance. I was looking at that region near 2880. We probed into that region earlier today, and that's sort of what marked my initial inclination here to try to press this lower. We just came ahead of it. So here's that near-term confluence. And again, a little bit of a messy chart, but here's what we looked like last night, and here's what we look like now. So you had this was the major parallel that we were looking at early on, right, in yesterday's webinar on daily effects. On closer examination of this last night, I saw a really interesting parallel extending off that spike high that we made a couple weeks ago. Okay, although we broke through it here in late May, you can see some really nice pivots here into the June open. It was the origin of the break and the opening range break last week, which gave us that drop, and that converged on the upper median line parallel. So we highlighted a region around 128.80. We just came just shy of that in this morning's rally. There was some divergence both on the 30-minute chart here and the 5-minute chart and the 1-minute chart with a decent trigger that gave out. So I'm in a short on this one. I'm looking for initial target at 28.30. By the way, again, 28.30 was a big level. That was the October low. So, I'm not looking to press the short any well, let me take that back. I'd be looking when I get to 28.30. I'll be taking off 3/4 of the trade and going break even on the rest because I do think that it does risk still a break towards 30.20, maybe 30.75, 30.90, this region up here, uh, just on account of what we're seeing with the rebound off the low. That said, this is the first area you'd expect to see some resistance. And keep in mind one other thing. This break, again, you can interpret this as a near-term break of the initial weekly opening range, which would keep your focus higher above this region anyway. So the region in focus, long story short, guys, is going to be that 28.80 region of resistance into 28.30, that October low. And that's really what we need to get back below if we're going to continue holding within the confines of this formation off the highs. Near-term confluence resistance here in dollar CAD. Any questions on dollar CAD? I guess there's that trigger. I just wanted to show you the trigger. So divergence into the highs, and this is a really nice divergence signal because the high is much, much higher on a closed basis, even on the 5-minute or a 1-minute chart. With a near-term trigger break, put us with a stop against the highs. Again, on this trade right now, guys, keep in mind the ATR is expanding actually for dollar CAD. We were actually pretty big on this, 28 pips. You were looking at like 24 last week, if I'm not mistaken. So you're looking for about 30 pips, just shy of per scalp. On dollar CAD. Any questions on the loonie? From where we were last night or where we are right now? Okay, last but not least, we got to jump into the euro dollar. Obviously going to be a trade that everyone's looking at, especially as we head into Brexit. The highlighted pairs are going to be euro and sterling, and euro sterling, which will also be a very interesting pair I'll be watching. But looking at the euro dollar, which I didn't highlight necessarily yesterday, but it's the same levels from last week. There's been no change whatsoever. I actually haven't been really interested in playing euro dollar at this point. I can tell you that I know that obviously the swing trades got stopped out on this one yesterday. I am looking at near-term support here at a key 618 retracement just from the advance off the lows. And then this is the 100-day moving average, which comes in at 112.13. Okay, so 112.13, 112.17. You saw a low of 112.08 before this thing rebounded higher. It set a weekly opening range, guys. That's all I got to say on this. If you put a gun to my head and tell me what to do here on euro dollar, I'd say look lower for a long exposure still. We're still trading broadly within the confines of this ascending formation. Here's what the euro looks like on the daily. Here's their initial rebound off that 100-day moving average. But, the risk from here is for a move lower if we do break this low towards like 111.30 before you start to look for some re-entry on the long side. But that being said, near term, not quite convinced that this is going to be a full-on breakdown for the euro yet. So we will see. I just wanted to highlight these levels, guys. Keep these levels in mind. We'll give you an update on this once we actually get some more clarity on the near-term directional bias. But on its face, it's made a pretty decent weekly opening range. We'll be looking for a break of that to validate our near-term outlook. Questions on the euro? All right. So, Gary, let's jump into the abomination for you. Here's what the dollar yen looks like. All right. Again, on the yen strength, it's a story of which I'm not necessarily interested in participating personally, just because I don't really see that full clarity in some of the levels. I know I've talked this countless times with Jamie. As far as dollar and the yen is concerned, if we get a more dramatic, and this is why I think this pair actually will be exceptionally important heading into tomorrow. Let's check out the scenarios here. If we get a scenario where the Fed, is less hawkish or even dovish. Remember, guys, the last time we saw Yellen speak was at a private speech that she was giving, and she continued to reiterate the fact and reinforce the fact that she expects rates higher within the next quote-unquote few months. Okay? That was before non-farm payrolls came out and basically crapped the bed, right? We got the weakest print that we've gotten in months. We saw labor force participation rate decrease, and we saw let me take a step back. We did see wage numbers start to increase a little bit, which is a good thing for the inflationary outlook, but certainly puts a curb or curbs the appetite or sets a high bar for the Fed to really be able to move on rates. You got concerns in China, you got negative rates in Europe, you got the Brexit coming up in a week. I doubt that they're going to move on rates, but the tone and the quarterly projections will be paramount. So as it pertains to growth, inflation, interest rates, we'll be getting all these projections tomorrow. If we get a risk-off environment, I would expect to see yen strength to outpace dollar strength. Why is that? Because if the Fed comes out on a more dovish stance, you're going to get those interest rate expectations kicked out even further. Okay? And if we get a risk-off environment, while that typically will be supportive of the greenback, I do think that the yen will get a little bit more of a play on that release. Now, on the contrast, if the Fed comes out and says, you know what, all of you started freaking out about that non-farm payroll number for no reason. Okay, we're still on pace to move this year. Remember, Fed fund futures are pricing in zilch. So if that kind of commentary comes out, look for the dollar to really be the master or the pusher in this pair. So the only thing I'm looking at here, 105.43, which is just a swing high that you made for the 2014 opening range. You tested it again as support later that year before moving into the high. And that level coincides. Oh, that's it. So that's near-term support near 105.43. Here's what it looks like on the 30-minute. Okay. Okay. So here's what I would say on this, Gary. You're marking some divergence into the low since last week. Lower low, lower low, lower low, a series of higher lows. And you do have a resistance trigger that's pending in momentum. Something like that. There's your divergent signal. Consolidation of momentum. On a topside break, I do not want to stress these retracements anymore. So let's do this. By the way, again, way too early. I don't know that this is a concerted low, but if we do see that rebound topside break of the Asia Open, and this comes just above the open for the week. So those are the levels I'd be looking at, Gary. Again, not a pair I'm going to be necessarily trading personally, but something I'll definitely be looking at heading into the event risk for the U.S. Tends to be some pretty major data, or tends to be a pretty big mover as far as U.S. data is concerned. So heading into the FOMC, for sure, you'll definitely see this moving. It's just for me, near term, I don't really have clear-cut targets. Again, these are sort of the initial levels I'd be looking at as far as scalp targets are concerned. Remember, you're looking at about a 30 pip ATR here for a quarter of the daily ATR. But those are the levels I'd be looking at. I'm pretty neutral here. Again, if you put a gun to my head, I would say that this thing is going to rally harder first. Look for 107, 107.80 even. Basically looking for the underbelly of this formation that we broke back below last, this is 2 weeks ago at this point. I'd be looking for a rally back into that underbelly before moving lower. Not to mention that, for the month of June, we've made a pretty radical stretch as it stands. So it sort of bode pretty well to see that last rally before we come back off again. Gary, does that help on dollar yen? I wish I had some more conviction for you on this, buddy, but she's a tricky one here. She's really tricky here, and there's a reason I call it the abomination. He says, helpful as always. Thanks. You're more than welcome. All right. So real quick look back at some of those radar charts from last week. I do want to just cover really quick where crude prices are trading. This is what we looked at last week. We talked about 51 and the severity of that confluence, not only the October high, not only the 100% extension, but also that basic median line resistance coming off the highs. We got a probe through, outside reversal off it. Beautiful, beautiful technical indication that you're likely to see this thing come off a little bit more aggressively. Here's what crude oil looks like now. There it is. Okay, so we're basically right at support as we stand right now. Okay, this is a sliding parallel extending off the April low after the reversal from that high. Do want to point out a couple of things. I talked about this in the webinar yesterday on Daily FX if you were with me. Not only do you have the lower parallels here, but I do want to just highlight the monthly opening range low comes in at 47.73. So that, for me, is the break I kind of need to see to validate a more significant, meaningful reversal here in crude. That being said, guys, we're simply at uptrend support. Okay, not the time to get bearish from here. Okay, when we talked about 51 last week, that was the time to get bearish. From here, you're at support. All right, if we do see a break sub 47.73, which I suspect at some point we will, I would look to see a rebound back towards that as resistance to look to initiate some fresh shorts. But as it stands, monthly opening range is set, and we're on the 14th of the month. So certainly a break of that opening range at this point, in my opinion, would certainly validate our medium-term directional bias. Keep in mind, we went over this yesterday too, a lot of the opening range breaks for the month in crude have been quite fruitful over the last couple of months. Last month's opening range break happened on the 12th. You saw that stretch into a late month high. The previous month's opening range broke here on the 20th. That stretched into a late month high. And we can go on and on here over the months. Again, it's not a strategy that's going to win 100% of the time, or a factor that you can use for your trading 100% of the time. But certainly when it's a clean setup, and when it's something like what we're looking at right now, outside reversal at the highs, major resistance, now checking the monthly opening range low, a break here would certainly validate a shift near term. So from here, what should I be looking for heading into the U.S. session? I would be looking for some rebound. Okay, maybe a little bit of a short covering rally, maybe a little bit of a pop higher here before finally breaking. But I am expecting, or I'm looking for validation for our downside bias with a break of the monthly opening range low. All right, that is crude. Again, certainly we'll be looking at what's going on in reference with dollar CAD, as well as some of those just base dollar movements that we're seeing, right? If the dollar continues to strengthen, or if we do see some serious radical strength on some of that Fed commentary, you could see crude prices reacting pretty aggressively as well. I'm going to go ahead and shave off a little bit of that dollar CAD trade at this point, guys. We're about 20 pips up on that. You're heading into some near-term support. Remember, a quarter of the daily ATR and what that represents for us at this point. So do keep that in mind. I'll continue to give you updates on this. If we get into 28.30 again, I'll be taking off 3/4 of the trade and just leaving a quarter on with a stop at break even to see if we can't get that last drop towards the range lows. Okay, any other questions before we wrap things up here? I made good time today. Oh, gold. Quick look at gold. There's really nothing to do here if you're not already long. I can tell you that, well, let me show you the daily first. Well, here's the weekly. Okay, this would be the third week of consecutive advances. I do want to show you that the high week close for um, 2015 is pretty much the high close for this year. Okay, we talked about this yesterday. Breaks it basically takes into 1291, 1293. It also ends up being the high day close for this year. So there's a lot up here. And I do think that gold has the propensity here to slip into this key region of resistance, 1291, 1293, before anything. But guys, I wouldn't touch this if you're looking for re-entry, even from scalping standpoint. Um, just be careful. You're heading into, gold will definitely be a strong reactor to the FOMC because of the implications of monetary policy and the interest rate outlook. If interest rates get kicked out much further, you'll likely to find a bid. Okay, if you see interest rates be brought back into 2016, meaning we could see a December print or we could see a December hike, I would expect gold prices to take a little bit more of a hit. Well, if the outlook is coming in, you can get better rates putting your money in a bank. There's no reason to kind of dump your money into gold, which does not pay a dividend. And again, the transaction holding costs there within kind of limit the appeal, let's call it, of gold. So I'll be looking for this trade to see if we can cap out or find some near-term resistance on a turn here, but it's been a pretty strong ripperoo. Again, high week close, high day close, 1291, 1293 is really the only thing that you're looking for. The only thing that would put me bearish at this point would be either a spike into that 1293, 1291 level, which would be really nice with that upper parallel if we get a little bit of a stretch, or a break of the weekly opening range low. Okay, and that would entail a move sub 1272. Mario says, quick comment on the S&P, please. Absolutely. So SPOOS looks like this. You're now checking the 50% retracement. I do think this heads lower, directly lower from here. I don't know. I don't really have scalp charts available on the S&P, Mario. It's been a couple of years since I've traded futures contracts for scalping on this. But what I can tell you is this: the momentum signature, obviously the divergence you marked into the highs, price action making a higher high and a close basis, the oscillator making a lower high, rejection at 60, breaks up 50, all things that suggest you're seeing some near-term exhaustion to the upside. A turn ahead of the median line, a turn ahead of the high day close. This was also a break of the monthly opening range low. So from an objective standpoint, this would give you a near-term short bias. Okay, looking for 1261. The yearly open at 1257 is as low, as I would probe on this trade. So let me just open this up for you. So if you want to take a snapshot, Mario. So that's what I'd be looking. Could get a rebound off this region here in U.S. trade today, but I would be cognizant. I'd be looking, as long as we stay below the monthly open at 2103, I would be looking lower. He says, good, thanks. More than welcome. Since we have the time, I do want to just drill into this really quick and see what the 30-minute looks like, if anything. Here's the weekly open. Okay, you're getting some divergence into those lows. So as I said, expect that you could see some pop higher here. Okay, too soon to use this because you haven't got any pivots off it just yet. But just one thing to keep in mind. Actually, scratch that. So, Mario, if you take basic channel resistance off the highs from April, take that to the lows. You saw some nice parallel action there. Extend that to that swing high that you made on the 25th. You can see that it caught the lows here, June opening range, and it literally caught the low that we made today, almost to the pip. So could be a slope that you might want to pay attention to. Yeah. Right? Nice. Consolidation, pop higher, break below, gives you the acceleration. Looks pretty good, actually. What? Stop traffic. This looks really good. Okay. Okay. So heading into U.S. trade, could see a pop higher. Wouldn't be surprised if we do see a break on top of the Asia Open, so like 2075. Tack on a quick retracement. See where. Let's just do it right now together. Maybe up to 2089, the weekly open. Yeah, and some of those lows there, 2085, 2089 would be a decent area to look for some initial resistance on a pop higher. Major key support, like I said, 2057 yearly open, 2061 key 618 retracement. All right. Mary says, good, thanks. Yes, that was what I was looking at. And the divergence, of course, yeah. Yeah, you do have it. It's there, man. I wouldn't be surprised. I'd be looking for a pop higher here near term. Before this starts to turn any lower from here. But I would definitely be cognizant of that major key support. Basically heading into the yearly open at 618. Really, really critical. All right. So with that, Kelly says, hello, pal. I didn't record the level we were looking at for the Kiwi dollar to drop down from this level. Let me take a snapshot for that for you. Here's Kiwi dollar on the 30-minute, Kelly. So you had 69.66. If you do see that break of the downside, that'd be the first level. But here's what I want to say, Kelly. I know you got the picture. Here's what I want to say. The daily chart, right? It highlights all the way into 69.70. Okay, so keep that in mind. As far as the support structure, I'd be looking at 69.70 into this region. So for me, on a short bias, you're basically looking for 69 as your first target, I would say. This is at 66 is the 38 too. And that's the break that would validate a much more significant reversal. But watch this whole region just below 70 on a 20 pip gap or a 30 pip, not gap, but on a 30 pip range here below. Starts to get a little hairy. I don't want to stress it because obviously on the daily chart we've sailed through this quite a many times. But I just do want to be cognizant. It is the March highs that we made for the year. It's that longer dated 50% retracement, and could be a level that might offer some volatility. So just keep an eye on that. All right, Kelly. Always great to see you in the room. All right, guys, we will go ahead and wrap this up for today. Again, we'll pick it up tomorrow morning ahead of the Fed. We'll give you a nice quick update on all the dollar crosses and what we're looking at heading immediately into the release. Again, the Fed release will be at 2 p.m. is when we get the presser with Janet Yellen, where we'll go over much detail the quarterly projections, and we'll also get that presser. We'll get a little bit more of a tell as market participants press her on really where the Fed is at this point with the data that we just got and the weakness that we're seeing abroad and the Brexit and all that. So should be a very, very interesting day. We'll pick things up tomorrow morning at 8:30. Best of luck trading, guys. Cheers.